based, it's psychology based, and it's actually based around things like double bottoms or triple bottoms or baselines of support or resistance. And a lot of people say, okay, what happens if somebody's got heavy long into this? What happens if somebody's been buying into these phases here and the price breaks south? Well, the formula is very, very simple. If you go half back, you allow an averaging in trader to close their position for a small profit, or at least a profit of some description. So in other words, if you allow people to buy, if this price breaks and people are still long, there's obviously going to be an averaging in process. This may well start averaging in as the price drops. If you average in as the price drops, then obviously if you take the price back up to the halfback here, anything above this area allows the averaging in trader to clear the book at break even. So this is a break even for the averaging in trader. This is why when you see that type of pullback against a balance line, a lot of the times it gets very close to that level. Sometimes it just touches it because it doesn't give enough volume for them to get their size off. Sometimes it just gives a little touch to that level and then breaks away from that without allowing any of those averaging in traders to do any business. Why is that important? Because now they've got a choice of having to buy an awful lot more, or it's too much pain and they capitulate as that price starts selling away from that level. They capitulate, and that causes the next leg lower. Does that make sense? Yes? It should obviously have a, you should obviously kind of have an idea about this. I'll give you an example of how this sometimes plays out. So it's a fast money breaker against a key balance or a key reference point. It's always something you're going to be looking at when you see a breakaway. Now, if the price comes back to the previous breakout price, then that's obviously, it's already cleared anybody that averaged in, right? It's already cleared anybody that averaged into that trade. But if it breaks without averaging, you're obviously going to be looking at it saying, oh, these guys are now absolutely busted. So anytime the price pulls back and then starts selling off again, you'll normally get a sell-off. And the reason why I'm remembering this point is because somebody asked a question about, what was the question now? It was going back a while ago. Somebody asked a question, and it was about, I can't actually remember what the question is, but it stimulated that, point about how far back does a price have to go to allow averaging in traders to get away from the deal. And and that's how you kind of calculate out some of that information. That's how you calculate it out. So if it doesn't go that half-back trade, it's highly likely that anybody that's in this, if it doesn't go back to the half-back, it's highly likely that there's going to be a lot of selling pouring in behind here. And that gives you that extended leg lower through that phase there. I hope that makes sense. I've not explained it particularly brilliantly, but it's something that you could perhaps start to see on many of the markets, for example. So let me just show you one. Let me show you one on oil here. Why? Because there's a fast break. Okay, so you can see one on oil here. If everybody's selling oil here, if everybody's using that line to sell oil, and they all get short oil, when the price finally breaks out of that area, you see that fast break. If people are still selling it, then obviously as the price goes up from that point there, every time the price pulls back away from a pullback, if it clears the halfback, it's usually enough for people to balance out. If it's got to clear the halfback, touching the halfback's no use because there's no volume. So it's got to clear the halfback. If it goes higher, it's got to clear the halfback for people to square. If it goes higher, it's got to clear the halfback for people to square. Look at what happens. It never clears the halfback, does it? And because it never clears the halfback, what happens is the buyers come in here and press. There's possibly some people coming in here and pressing, and there's some people coming in here and pressing. So these buyers can't, these sellers that were in at the bottom edge can't ever get away from this trade. See that? They can't ever get away from this trade. So they're busted. If they don't close out the position, they're absolutely busted. It's just an averaging in process. Now, obviously, at some stage, everybody's going to be busted. So obviously, when you're looking at that from a measure point of view, you start saying to yourself, right, they've gone far too far. Anybody that was going to get busted is now busted, yeah? And that's usually into this measuring phase here. Anybody that was short that balance area, trying to make a measure to the downside, or their stop is 1-to-1, maximum, worst case 1-to-1, they will all throw away their last positions at that price. And that's when you stop looking for that narrative. Once you've went the full measure of the balance area that you're trying to calculate. Understand? Comprende? Aye. So when we understand that, we can start to recognize any balance area. So you could recognize this balance area here, and you say, right, if everybody was averaging into that sell, if people were selling off that trade there, where is it that they're going to be not able to get off that trade? Well, you can see they were able to get away from that trade here. They were able to get away from that trade averaging in, but it pinned it straight away. So did everybody manage to get off of that trade? Probably not. The volume wasn't that good. The volume was tiny, in fact. So there's a possibility that these dudes are still in this trade. So when do they finally give up the ghost on this? They give up the ghost at that price there, don't they? They give up, and then there's this big capitulation. That's it. They're all finished. Finito. And there's a lot of business comes in these areas. That's what you see, huge volume pins coming in. The sellers that were in this balance, they finally give up here, and that obviously gives traders an opportunity to do business up here. That's right, David. That was a question about the halfback trade, super bearish or super bullish. And I was trying to think of a way of trying to answer the question better than I did. And you know, when I was thinking about it from the simple arithmetic point of view, it made more sense to be able to answer it that way. So I don't know if that helps to answer the question a little bit, but it's really only relevant for super fast breakout trades off of balance areas. So for example here, there's a super fast breakout trade here, and you can see they cleared. They managed to average into that position before they got busted. So the sellers in here got away from their trade here. They managed to get away from that trade itself. Now obviously if they sold this triple top up here, and you start looking at that, you can see they managed to pull back here, but there's probability that they didn't get everything cleared at that point. There's still guys that are probably stuck in this trade, and you can see as you go higher, you'll find what happens is that they don't allow the price to go much below, if at all, go below the 50. That's why you see that 50 there. Because two-way money starts coming in here as people start averaging out their short positions. And that puts a lot of buyers into that 50 line, David. It puts a lot of buyers into the 50, because if they've been selling and they've been averaging, right? So they sold this high for argument's sake here. They then sold this high here, and then they've been busted when the market failed auction. And they've been averaging this trade higher. They've been averaging this trade higher here. Well, their average trade higher, they've realized they've got a bad trade, right? Everybody knows they've just got a bad trade here. So when it hits this price, they could probably clear a profit or a scratch. The more it goes through that level, the more they can clear the profit, of course. But if it stops at the 50, they're obviously hoping that that trade is going to go lower. They're hoping that trade is going to go down into this area where they can actually make a very substantial profit. But if it stops at the 50, these guys are now in panic stations. And what happens a lot of the times then is that we start seeing that panic buying to close off a losing position, because their losing position isn't that bad, but if they leave it even for 4 or 5 ticks, their losing position goes from not that bad to absolutely appallingly bad. So the difference in the payoffs become massive, David. You see that? Every time, because they've been selling all the way up, as soon as that price doubles back, they're losing a fortune on all their whole position. And that's why we sometimes see that kind of break away from those areas, because these guys are now basically busted, aren't they? They're completely and utterly busted. So you can obviously start to understand this as a narrative as it develops out into these stories. And it's just a little pointer to allow people to kind of recognize the simple arithmetic that goes into some of these simple concepts.